Hey everyone, welcome to our mortgage market update for April. I'm Steve.
And I'm James. As we've talked about before, mortgage rates can and do move separately from the Fed Reserve and the federal funds rate. However, the Fed policy in general has a big impact on rates, which is why when the Fed speaks, markets listen.
When the Fed is looking for signs that it may be time to start lowering rates, they're looking at two main things: inflation and unemployment.
Inflation, though definitely slowing, has not yet come down close enough to their 2% target. And as we learned this week, employment also remains very strong.
Yes, the much anticipated jobs report for March came in this morning, and the numbers came in well above estimates. Increase in new jobs was the biggest we've seen since May of 2023. Not to be outdone, the unemployment rate slipped from 3.9% to 3.8%.
We've seen other stronger than expected economic reports come in recently, none of which have helped mortgage rates.
So what does this mean for interest rates? You listen to Fed members, not that much. They're definitely still in a wait and see mode.
Despite all this data coming in recently that proves the economy just keeps humming along, there's still plenty of folks expecting multiple rate cuts this year. When that will happen and by how much is still up in the air.
Fed Chair Powell said policymakers will wait for clearer signs of inflation slowing before any interest rate cuts. However, he said that the recent hotter than expected economic data doesn't change the overall view and it will likely be appropriate to start cutting later in the year.
Minneapolis Fed President Neil Kashkari said this week that progress on inflation has stalled, which could leave the central bank unable to cut rates this year if the trend continues.
Philadelphia Fed President Harker said inflation remains too high, while Richmond Fed President Barkin said it would be smart for the central bank to take its time before lowering interest rates.
And traders are now betting the Fed will deliver fewer than 3 rate cuts this year, a view that was likely supported by the job numbers that just came out for March.
In other news, the home price index was rising in February, according to CoreLogic. We are seeing a similar pattern last year where the rate of home appreciation slowed in December and January, then started to rise again in February and March. As always, check in with your local market expert on this.
An interesting stat here. According to Redfin, a typical homebuyer's down payment is up 24% from a year ago. People are finding ways to put down more to lessen the bite of interest rates and higher mortgage payments. Also, home values continuing to increase will impact this.
Lots of discussion and speculation about the recent NAR ruling about realtor commissions. For us, the main thing we'll be monitoring is how we look at buyer's agent commissions and who pays them. Will they be included in the maximum allowable interested party contributions? If so, that could have a real impact on a borrower's down payment and how much they need to bring to closing.
We'll be keeping a close eye on this, and please reach out if you want to have a more in-depth conversation about it.
A quick note on loan products. We're seeing a larger number of borrowers taking advantage of our bank statement loans and our asset qualifier loans. The bank statement loan is for self-employed borrowers whose tax returns may not tell the whole picture, so we qualify them off their business or their personal bank statements.
We also have an asset qualifier loan for borrowers who have a good amount of assets but not enough reportable income to qualify. Both of these loan products are great financing options for borrowers that may not fit within the conventional box.
Thanks for staying checked in with us, and don't hesitate to reach out with any questions or commentary.
Talk to you later.